Hello, everybody. Thank you for joining us today. We are happy to have all of you with us. I'm Allison Helland. I'm the Director of Donor and Advisor Engagement at MCF, and I've been at MCF for about 2.5 years. Prior to that, I was an attorney in private practice, so these webinars are always really interesting to me too, kind of keep up with things. Before we get started, I did just want to thank all of you for your time today and also for all of the work that you do with your clients and colleagues and communities around charitable giving. We really appreciate that. We're honored by it. And we wanted to create these webinars as a means of bringing everyone together to talk about the types of work that they're doing and share ideas. So thank you for everything you do. And we are always happy to be a resource to you. Today's webinar is the third of 4 webinars we'll be hosting this year. We have a 4th webinar on November 14th called 7 Tips for Helping Your Clients Make Effective Year-End Gifts. I'm really excited about this. We will be joined by our Vice President of Finance and Operations, Carmen Jeschke, who is very involved in the operational and procedural end of gift processing. And I think she has some really good tips that advisors can benefit from as far as, what conversations to have with the client up front, what things you can get to us up front, and basically how we can make sure that your client's gifts get processed effectively and as quickly as possible. So before we jump into our program and I introduce our distinguished speakers, I wanted to give you a few housekeeping updates. If you are an attorney licensed to practice in Wisconsin and you are listening to this live cast, not a replay, live class, you are eligible for 1 CLE credit. So that has been approved by the Board of Bar Examiners. Like I said, if you have, if you are listening to the live or replay of this, that will not qualify for credit. Our webinar on November 14th has been approved for 1 CLE credit. So I know we are getting near the end of the calendar year, which for half of you attorneys means you're going to be reporting. So if you would like another CLE credit, November 14th, that will be at noon. If you do have any ideas for future webinar topics, if there's something you're interested in, you'd like to see us convene a webinar around, please contact me. Always happy to chat. Always happy to read emails and get feedback from advisors. I want to make sure we're getting material and content that's relevant to you and that's helpful to you and helps you help your clients with charitable giving related activities. So with that, one more thing I just forgot. If you have questions for our presenters, you can use the Q&A function in the Zoom screen that you have in front of you, and that will pop up for the presenter. So we will try to address those as we go during the presentation, but that is the way that you can submit your questions. So without further ado, I'd like to introduce our 2 speakers. I don't think they probably need an introduction. You probably know all of them. They're both leaders in both just technical expertise in charitable planning and working with clients. So our first speaker is Johanna Allex. She's a CPA and a lawyer and a partner at the Madison office of Stafford Rosenbaum. Her practice focuses on all areas of estate planning and estate administration. She also works as an impartial mediator to help families and individuals resolve disputes involving probate, trust administration, and guardianships. In addition, she regularly lectures on topics such as estate planning, alternative dispute resolution, and operational issues of importance to nonprofits. She has also taught a practical seminar on estate planning and administration as an adjunct at UW-Madison's Law School. And in addition to all of this, she is also a member of MCF's Professional Advisor Council, which is a group of really distinguished advisors in our community that help me figure out how best to help you as advisors. So we appreciate people that take additional time to work with us on these things. So I thank Johanna for that. And then our second presenter, E.G. Schramka. He is the Executive Director of the Irwin A. and Robert D. Goodman Foundation. He spent over 40 years providing tax consulting services to closely held businesses and individuals, in addition to estate and trust planning before retiring from SVA. He holds the Personal Financial Specialist and Accredited in Business Valuations certifications from the AICPA. In addition, he is a member of MCF's Board of Governors and the chair of our Professional Advisor Council. He was also a member of MCF's 2023 CAP study group, and he holds the Charter Advisor in Philanthropy designation. If you would like to learn more about the Chartered Advisor in Philanthropy designation, shoot me an email, give me a call. I would be happy to talk with you about it. So with all of that out of the way, I am going to turn things over to E.G.
Thank you, Allison. Good morning, everyone. Thanks for joining today. Um, the charitable techniques that we're going to talk about today, charitable gift annuities, charitable remainder trusts, charitable lead trusts, they will save potential donors income taxes and estate taxes. However, if they do not meet the prospective donors' personal objectives or their income needs during their lifetime or the income needs for their survivors, then those charitable techniques really aren't a viable option for them. So keep that in mind. Personal objectives, income needs for the during their lifetime and for the survivor take precedence over any of the tax benefits that we're going to talk about today. So on this slide, we have just a very brief definition of charitable gift planning. I want you to focus on two things in that definition. The first one is these methods can be used during lifetime or at death. And by integrating all your goals, be they charitable, family, or financial, you can leave a legacy, a charitable legacy for future generations. So, why should you consider a charitable plan gift? Well, there's non-tax and there's tax reasons for that. And like I said earlier, under the PIT approach, you should be focusing on the non-tax reasons first. So let's say a prospective donor has an asset that they bought years ago that isn't income producing, has a low basis, but has appreciated significantly. If they were to sell that asset, they would generate a taxable gain, and it may be a big part of their portfolio. By using some of these techniques, you can diversify your investment portfolio, increase your income. You could make a larger charitable gift than you thought possible, leave a charitable legacy for future generations. And it can also, reduce your income taxes and your capital gains taxes. So numerous non-tax and tax reasons for doing a charitable plan gift. So sometimes I like to simplify when we talk about, charitable plan gifts to a client to make it easier for them to understand. So I use an apple tree analogy. Now, as a sidelight, there are 2,500 varieties of apples in the United States. And the most popular is a gala apple. But what apple is not an apple? That would be a pineapple. So let's go back to the apple tree analogy. So with a potential donor, they own an apple tree. They could give away a few apples a year, and that would be an outright gift in that particular year to a charity. Or they could give away the entire apple tree to the charity, either during lifetime or at death, and that would be a current charitable deduction, either for them or for the estate. Now, they could give away the apple tree and just keep the apples for as long as they live or for a term of years. And that's the analogy for the charitable gift annuity and for the charitable remainder trust that we're going to talk about. Or they could just give away the apples for a number of years, but they would retain the apple tree. And that's going to be the discussion that we have on the charitable lead trust. So just to start with a client, I just like to simplify it for them and say, okay, here's how these would all work under the apple tree analogy. So let's talk about a charitable gift annuity, which is going to give more in detail in the next two slides. But let's say a prospective donor gives cash or securities to a charity. Okay. They would then receive back an annuity, and it would be over their life expectancy. They would get a charitable income tax deduction in the year that the annuity was set up. And the annuity payment is going to be based upon their age and upon the given the current rate, and we'll talk about that later. When they receive the annuity payment, the payment is really broken down as follows. Part of it will be an actual tax-free return of principal. Part of it could be capital gain, depending upon if they gave appreciated property, and then the balance would be taxed as ordinary income. They would get a charitable income tax deduction in the year that they set up the annuity, and at the end of the annuity term, whatever's left goes to the charity. Now, this annuity could either be for the donor's life expectancy, or the donor could name another person as the annuitant, or you could do a joint annuity. If another person other than the donor is named as the annuitant, then you have gift issues to deal with in that case. So, what are the different types of annuities? Well, the most common is an immediate annuity, where you just transfer the money and the annuity begins right away. You can also do a deferred or a flexible deferred annuity, where you postpone the start date to a date of your choice sometime in the future. But most of them are going to be immediate charitable gift annuities. So let's do a very simple example, and remember the apple tree analogy, where the individual owns an apple tree. They're giving the apple tree entirely to the charity, and they're going to receive apples for their life expectancy. Now, as a side note, the most popular pie in the United States is apple pie, but that was actually invented in England. And then why did the apple pie crust go to the dentist? Because it needed a filling. All right, so let's do the example here. So I have an individual age 70. They have appreciated stock, which is now worth $50,000. And when they bought it, they paid $20,000. So if they were to sell that stock, they would realize a taxable gain of $30,000. But instead, they decide to give that to the charity. So they give the stock worth $50,000 to the charity. Okay, they don't have to realize that appreciation as a taxable event. In return, they're going to receive annual payments of a little over $3,000 based upon a gift annuity rate of 6.1%. Of that $3,050 annual annuity payment, $756 is tax-free, and the balance will either be taxed as capital gain or ordinary income. This individual would also get a charitable deduction of just under $20,000. Now, whether or not they can get a tax benefit for that deduction depends upon whether or not they're going to itemize their deductions. Now, under the current law, about 90% or more of taxpayers do not itemize deductions. They take the standard deduction. But depending upon your tax situation, they could get a charitable deduction for $20,000. Now, the gift annuity rate is set by the American Council on Gift Annuities. And depending upon your age, the older you are, the higher that gift annuity rate would be. And if you do a joint annuity, that's going to be a little lower than if you do a single annuity. So for example, the current single rate is for a 65-year-old, 5.7%, for a 70-year-old, 6.3%, and for a 75-year-old, 7%. And for a joint, if they're both 65, the current rate is 5%. If they're both 70, it's 5.5%. And if they're both 75, it's 6.2%. So you notice the older the individual is, the higher the gift annuity rate is, and it's lower if you have two annuitants there. But as you can see here under this example, the individual was able to avoid the tax on the unrealized capital gain and also give himself some income and a potential charitable deduction. So, right. So now I'm going to turn it over to Allison so she can talk about how MCF can work with you in the area of charitable gift annuities.
Thanks, EG. So we do offer charitable gift annuities at Madison Community Foundation. In order to qualify, you do have to be at least age 60. So that's one of our requirements. We do use the rates that are set by the American Council on Gift Annuities, which EG just discussed. They're very simple to set up with us. Basically, you just contact us, tell us you'd like to set one up. We require a minimum amount of $10,000 if the remainder gift will be supporting an endowment that already exists at MCF. If it's going to support a different organization or endowment where we'll need to create a new endowment, the minimum is $30,000. So when working with clients, those are kind of the two things you need to remember is either the $10,000 and the $30,000 and age 60. So basically what we do is we put together a charitable gift annuity projection for you, which will break out many of the things EG mentioned as far as ordinary income, capital gains, tax-free recovery of principal, and kind of give you a breakout of what it would look like, how those payments would be broken down based on the annuity rates that are set by IRS. If you decide, the client decides they would like to move ahead with that, then we enter into a simple gift agreement that kind of sets out the terms of the annuity and then also designates the organization or fund that you would like to receive that remainder. So it's a very simple process. I have a lot of fund holders that like it if they feel like they want to make sure they're making a legacy gift that is meaningful to them, but are just not ready to completely let go of an income stream from it. It's a kind of a nice option for them to continue receiving those payments either quarterly or semi-annually, typically during their lifetime, and then having that legacy gift being made. There are a couple things I do want to bring up too that I think it would be great to have EG weigh in on is, one is the annuity rates. Typically, as the interest rates go up, the CGA rates also appear to go up and down. They have not changed since January 1st of this year. I don't know if that will remain with the Fed cutting rates. I don't know if EG, do you have any thoughts on that?
I do not.
Okay.
I've given up predicting anything.
Okay, fair enough. The other thing I did just want to mention is that, like EG said, obviously the tax benefit of this will depend on your client's situation. And if the standard deduction turns out to be higher, you may not be able to maximize that benefit, but this could be an opportunity for gift bunching. So, if you want to look at bunching to get gifts in 1 year to an amount that is significant enough where itemization does make sense and you get more of the benefit for those charitable donations, that could be something to consider as well. At this point, I'm going to turn it over to Johanna so she can give us some charitable trust basics and then jump into CLTs and CRTs.
Thank you, Allison. As we've been talking about, charitable trusts are tools to consider when working with a client that's just interested in charitable giving, but has either income tax or income needs or both that they need to keep in mind in this planning process. Going back to the apple tree, I think I've got this right. So the charitable trusts have to do with giving away apples and retaining the tree, or giving the tree away and retaining apples. It depends on the timing. I think I've got that analogy right. But so that's kind of the way to look at that. My first experience with the charitable trust was, I think, perhaps the most unusual that I've had in working with donors with these tools. I was working with a woman who had inherited and then added to a very unusual and valuable collection of items. And she was also very charitably inclined, but she needed income from her assets. And so we looked at and created a charitable remainder trust for her. So in doing that, she had already identified a charity that she wanted to benefit. She identified an independent trustee to work with the charity with the trust. And so we just pretty much put this together. She contributed the collection to the trust. The trustee turned around and sold the items in an appropriate manner, and then took the net sale proceeds and invested them in publicly traded securities. So at the end of the day, my client was able to receive that income stream that she needed. She benefited from a charitable deduction because of the gift, and she was able to benefit the charity that she was really interested in seeing move forward in a greater amount, because she didn't have to sell the collection, pay the capital gains tax, and then contribute the net. She was able to do this without having to worry about the capital gains tax. So it's pretty neat. Charitable trusts have been around for a while, and advisors have said that this is a favorite for clients to consider because it reduces the cost of generosity. That was a quote from Conrad Teitel, who, well, for those of you who know who that is, it's sanctioned by statute, so that's good. There's some certainty there. And it can be complex to set up, but if you have the right combination of donor, assets, income needs, and desire to benefit a charity, then it's a really great tool to consider. So there's two broad categories of charitable trusts, and the differentiating factor between the two is really during the time during which one or more charities and other beneficiaries receive the benefits of the donor's gift. So the first type is the charitable lead trust. And this is the charity receives the gift first in the form of a payment stream, and then the trust terminates and the remainder beneficiaries receive the remaining trust assets. And the second is the charitable remainder trust, which is kind of the flip situation where one or more beneficiaries receives the payment stream for a predetermined period of time. And then after expiration of the period of time, the trust terminates and the charity receives the remaining trust assets. So in addition to two categories of trust, there's two categories of income payments. The first is an annuity, which is a steady stream of payments, and the value of the annuity is calculated as a fixed percentage of the initial value of the trust assets. And this is opposed to the unit trust, which is a variable stream, and it's equal to the percentage of the net fair market value of the trust assets determined at least annually for a specified term. So in terms of creating a charitable trust, first you have to identify the charity or charities and the non-charitable beneficiaries. And my experience is usually the client has already selected the charities and may have some idea about non-charitable beneficiaries, but so they're usually pretty well along in their thought process on these. As far as non-charitable beneficiaries, the client can name themselves, their spouse, or somebody else. It doesn't need to be they can be included in that, and they also do not need to be included in the non-charitable beneficiary category. Second is then to select a trustee. And I usually advise about appointing an independent trustee, at least as a co-trustee. And that's because it's just much more straightforward and easier to handle some of the pitfalls. The donor or a member of the donor's family can serve as trustee, but as I said, there's some considerations that have to be factored in, certainly if they're the only ones that are serving as trustee. Whenever there is a donor or a member of their family or the charity appointed to serve as trustee, then the assets must be valued by an independent trustee or an appraiser to make sure that there's sufficient arm's length in that. And one thing to consider, and this is why selecting an independent trustee might be a good idea, is that the donor can be given special powers. Otherwise, for example, the CRT, which is a tax-exempt entity, self-dealing rules might apply, or those powers may, in fact, cause estate inclusion of the trust assets, and we want to make sure we avoid that. And then you need to select the assets to donate. I think ones to think about are highly appreciated assets or assets that are likely to appreciate in the future. And there's some things to avoid with respect to charitable remainder trusts, and I'll get into that a little bit more when I talk about those types of trusts, but I just wanted to flag it now. And then also it's important when you select the assets to also identify and hire an appraiser for those assets, particularly if they're hard to value assets, because again, you need to make sure that your gift has the qualified appraisal requirements met. And then it's good to use modeling software to create projections so that the donor can understand how the different types of charitable trusts will impact them. I like modeling software because you can sit down with a client and set up one scenario, and then just with a few clicks of your mouse, change that scenario just based on certain factors that have changed, the value of the contribution, how much income is going to come out, timing, things like that. And it's neat for the client to see this in quote unquote real time, so they can understand how their decision making can impact the net result. It also creates a common understanding with the client and a record of options discussed with the client. These things are not all that straightforward. The client may have a really good understanding when they sign the trust agreement. Some years may pass and they don't understand why they got to the point that they did, or some of the considerations that they walk through with you. So the software is good for the file, frankly, and for the client's understanding, just to substantiate that. And then drafting the trust agreement. Now, the IRS has put together a whole slew of templates to use, and they're actually really good. And they did those so that you wouldn't need to go to them on behalf of your client to request a private letter ruling to okay the trust agreement that you're drafting and the structure that you're putting together with them. So if you follow those templates, chances are you're going to be really solid with respect to the viability of the document you're drafting. And then one last thing, I just wanted to mention that it's important for all of the client's advisors to be on the same page with each other and with the donor. Again, these are multi-factor tools, and with a little bit of adjustment here, a little bit of adjustment there can be big differences in outcomes. And so I think it's important for everybody to be on the same page and be looking at this in the same way, so that there aren't statements or options presented that could materially change what is being considered by the client without everybody understanding the net impact of those changes. Okay, and then to maintain a charitable trust, as you can imagine, there are some duties that need to be met on an ongoing basis. First is you need to make sure that an annual information return is filed. That's the form 5227. Those are for CRTs. And then also if it's a taxable, and I'll talk about this in a little bit, but you may need to file the IRS form 1041, the fiduciary income tax return for the CRT. And then the trustee must meet their duties, like preparing a trust inventory, making sure there's an annual accounting that's prepared, making sure that communications with the beneficiaries are all up to date. So all of those, just because it's a charitable tool, and there's a lot of planning that goes in on the front end, those trustee duties that would be there for all trusts must continue to be met. Okay, and then they can be terminated. They're not meant to go on forever and ever. Most of the time, well, the steps to terminating very often are determined by the reasons why the termination is occurring. The most common occurrence is that it's just the term is done. And, you know, the term that was discussed in the trust agreement has come to pass, and it's time now to pay out. And first step is determine the payout for the short year, and then to distribute the net assets to the remainder beneficiaries, whether they're non-charitable beneficiaries or charitable beneficiaries, and then to file the final information return or the IRS form 1041. Okay, so charitable remainder trusts. So this is where this particular flow chart is with a charitable remainder unit trust, and this is where the variability, the payment stream is variable, and it's based on evaluation of the trust assets each year. And in this example, you see that a $500,000 gift was made by the donor to the charitable remainder unit trust. The trust was for a term of 10 years, had a growth factor of 5%, and a percentage payout of 5%. And you can see that there's a number of income beneficiaries, which could include the donor. And then at the end of the trust term, at end of 10 years, then just under $300,000 will go to the charity, which could also be a donor advised fund. So it doesn't have to be a standalone charity. So you could couple this if you've got a donor advised fund already in existence, or another type of fund, say with a community foundation. You could name that as the remainder beneficiary of your charitable remainder unit trust. Let's see. So I wonder if you could advance the slide, please. Okay. So the charitable remainder annuity trust is similar to the CRUT, except for the payment. The income stream is it's solid. It's always the same. And when you're setting this up with your client, some things to keep in mind is that income stream can't be less than 5% or more than 50% of the additional assets contributed to the trust. Another thing to keep in mind is that unlike the CRUT, which the donor can make additional contributions to, you can't with the CRAT, the charitable remainder annuity trust. And that's because that income stream is based on a percentage of the value of the assets initially contributed to the trust, and that stays solid, stays the same. Okay, and then again, the CRUT, there with these CRUTs, the income stream is variable. It's based on a percentage of the assets as valued each year. And additional contributions can be made to the CRUT. There's variations on a theme of this CRUT, though. The standard is that the payment stream does go up and down based on the value of those assets. But you can have what's called a flip CRUT, NIM CRUT, or NI CRUT, and those are all ways to try to make or build a little more certainty into that income stream. And I won't go into all the variations on that theme, but just know that they're out there. Okay, so as far as the CRAT versus the CRUT, payments from the CRAT can't grow even if the trust assets appreciate. And we need to be careful about suggesting a CRAT if it looks like we're heading into a down market. And that's because the payment streams are going to be regular, the same. And there's a requirement that the remainder amount that goes to the charity can't be less than 10% of the assets initially contributed to the trust. And if that happens, then there's a loss in the tax exempt status of this CRAT. So we need to make sure that we understand, perhaps not predict, but can understand how this trust might fare in different markets. Let's see. Now, unlike a CRAT where the payment stream is the same, CRUTs have can have variable payments. So you can go up, you can get a larger payment if the value of the assets go up, but it also can go down too. And that's where we get some of these flip CRUT, NIM CRUT, NI CRUT, those types of variations on the CRUT can help soften the blow of the downsides in the market. And with the CRAT, you can't make additional contributions. With CRUT, you can. Okay, CRUTs require annual evaluations. CRATs do not. And CRUTs have been paired with an IRA as a way to mitigate the decrease in a beneficiary's ability to stretch the timeline for payments from an IRA from 10 years to their lifetime. But it comes with a cost, and we'll talk more about this when we get to the Secure Act in just a little bit. Okay, the next type is next type of charitable trust is called a charitable lead trust. And that's where you designate charities, one or more charities, to receive the income stream for a period of time. And then at the end of that period of time, then remainder beneficiaries, usually non-charitable beneficiaries, will receive what's ever left in the trust. And in this flow chart, we've got the $500,000 gift going to the charitable lead annuity trust. Term is 10 years, growth factor 5%, percentage payout is 5%. The charities are to get $25,000 per year. Could also be a donor advised fund. So this is another way to work your donor advised fund, including Madison Community Foundation, into your charitable planning. And then at the end of the 10 years, the remainder beneficiaries receive $263,218. With the charitable lead trust, there isn't a requirement related to that payment stream where it has to be 5% or more, but can't be more than 50% of the charitable lead trust assets. Let's see. So that's kind of just in a nutshell how a charitable lead trust generally works. And this is an annuity trust, so the payment would be a regular payment of $25,000 per year. Okay, so with charitable lead trusts, there are different types that can be put together based on the income tax objectives of the donor. There are grantor charitable lead trusts, and these are designed to give the donor an upfront charitable income tax deduction. The downside of this is that donor must be willing to be taxed on all the trust income. This is most often used in income tax planning where the grantor is anticipating a high taxable income year. And these are good when interest rates are low because the charitable lead trust is given a higher value, so larger deduction will be available to the donor. And then also if the assets appreciate greater than the 75/20 rate, more will be distributed to the remainder beneficiaries at a lower gift tax cost. So then you've got grantor CLTs, you also have non-grantor CLTs. And this is where the donor does not receive the upfront charitable income tax deduction, but the donor is not taxed on the income of the trust. The tax on the income of the trust is really felt by the trust itself, but the trust can claim an income tax charitable deduction for the amounts paid to the charitable lead beneficiaries. One reason why a donor might want to look at this is because, one, you're not taxed on the income of the trust, and also it's a great way to pull assets out of their estate for estate tax purposes. So you get the asset pulled out of the estate plus any appreciation on those assets. Then wouldn't be included in the grantor's estate, taxable estate. And these, actually, all of these can be done either during the donor's lifetime or based or within their estate plan on a testamentary manner. Okay, I think that's it for charitable trust for now.
Okay, well, thank you, Johanna. Two things I just want to add there with sometimes when you're dealing with a prospective donor and you're talking about a charitable remainder trust, there's concern about that it may reduce the inheritance that goes to their children or descendants. So sometimes you see that the prospective donor will then purchase insurance and then put it in a vehicle that's outside their estate, like an irrevocable life insurance trust, just to make up that difference then. And then the other thing I've seen with some clients with the charitable lead trust is that the recipient charity could actually be a private foundation that they have set up. So actually that annuity payment goes into a private foundation that's for the family. So let's switch gears. So we've talked about charitable gift annuities, and we've talked in part about charitable remainder trusts. And now we're going to talk about a way that certain individuals can use their IRA to fund either a charitable gift annuity or a charitable remainder trust. So the first thing we're going to talk about is just a little background on the Secure Act, because that's just a massive, if you saw the regulations on this, I think that's over 200 pages. So we're not going to cover everything here, but this was enacted in December of 2022. One of the provisions says that you must start taking your required minimum distributions from your retirement plan now at age 73. That increases to 75 in the year 2033. So all individuals have to start taking distributions from the retirement plans when they reach a certain age, and now that's 73. For qualified charitable distributions, or QCDs, which we'll talk about more later, they've now indexed for inflation the annual amount, and for 2024, that'll be $105,000. And like I said, it provides a mechanism for certain individuals to fund either a charitable gift annuity or a charitable remainder trust out of their IRA. So we've talked about charitable gift annuities and charitable remainder trust, and remember, under the apple tree analogy, it's a similar donor gives away the whole apple tree and then retains the apples for either a period of time or for their life. The primary difference between the charitable gift annuities and the charitable remainder trust is what is the source of the annuity payments. For the charitable remainder trust, it's the trust property itself, but with a charitable gift annuity, you are an unsecured creditor of that charity. So when you set up a charitable gift annuity, you want to make certain that the charity that you choose is in good financial condition in order not to, affect the future income stream. So just a little background here first on qualified charitable distributions, okay? So these only can come out of IRAs. They can't come out of other types of your 401k plan or anything like that. So just out of an IRA. You have to be at least age 70 and a half at the time of the distribution. So let's say I turned 70 and a half on November 1st. Even though I'm going to turn 70 and a half in 2024, I cannot do a qualified charitable distribution in July of 2024 because I'm not 70 and a half yet. You actually have to be age 70 and a half at the time of the distribution. The distribution has to go to a public charity, and donor advised funds do not qualify. As I mentioned earlier, the current limit is $105,000 in 2024, and that's now adjusted annually for inflation. We talked earlier that when you reach age 73, you're going to have to start taking minimum distributions out of your retirement plans. If you do a qualified charitable distribution after you reach age 73, that will count towards your required minimum distribution. So you don't have to take your required minimum distribution and this $105,000 coming out of your IRA. It counts towards that. The qualified distribution is not included in your income, but it's also not eligible for a charitable deduction. Now, as I stated earlier, under the current law, 90% or more of taxpayers use the standard deduction. Okay, so they're not getting a benefit. This gives you the best of both worlds if you're taking the standard deduction. You get the standard deduction, but you also get this to reduce your income without getting a charitable deduction. So I am seeing more and more clients who qualify using the qualified charitable distribution. Not to say they go up to the $105,000, but they're using it for, smaller gifts and so forth because they can no longer they no longer itemize deductions. So now let's talk about what is called the legacy IRA, which is using a qualified charitable distribution to fund a charitable gift annuity or a charitable remainder trust. Okay. Still have to be age 70 and a half at the time of the distribution. And even though the qualified charitable distribution limit is currently $105,000, the aggregate amount that can go into a charitable gift annuity or a charitable remainder trust out of your IRA is $53,000. Okay. And that counts towards the $105,000. So you can't do both $105,000 and then do another $53,000. Okay. If you're going to do the qualified charitable distribution into a charitable gift annuity or charitable remainder trust, it all has to be done in the same calendar year. You can't do $26,000 in year one and then do $27,000 in year two. It's a once in a lifetime limit that you got to do it all in 1 year. You cannot contribute any other assets into the charitable gift annuity. As I said, if you're 73 or over, it will count towards your required minimum distribution for that year. And the donor can only name him or herself as the annuitant, or you can add your or you can name the spouse individually, or you can do a joint. But the only two beneficiaries can either be the donor and his or her spouse. Now, one other difference, if you could go back, Allison, to the previous slide, thank you. We talked about earlier with the charitable gift annuity that when the annuitant receives the payments, a portion of it is a tax-free return to them, and then the balance could either be ordinary income or capital gain. When you receive an annuity out of this legacy IRA, it's 100% taxable as ordinary income. None of it's a return of capital or capital gain. It's 100% ordinary income. So that's a little different than what I'll call your normal charitable gift annuity. So once again, as I mentioned at the start, all these charitable techniques we talked about can save you taxes, be it income, estate taxes, but if they don't meet your prospective donors' personal objectives and their income needs during their lifetime, or the income needs for the survivors, then they're really not a viable option for that donor.
Okay, so which clients may benefit from a charitable trust? Well, donors who would like to create a legacy and to benefit certain causes would be good to consider. Donors who have highly appreciated assets and are interested in seeing the highly appreciated assets diversified in a tax-efficient manner. Donors who have a taxable estate, and donors who would like to receive income for themselves or their beneficiaries over a period of time. These are all donors that might be in the running for a charitable trust. So, but which clients may not benefit from a charitable trust? And this is not for everybody. Donors who do not want to give up any control of the assets. And this is important because we want to make sure that the gift, that the trust that's drafted doesn't include powers that would cause the assets of the trust to be included in their taxable estate. So they need to be okay with that. Donors who do not want to work with an attorney to establish the trust. Donors who don't want trust assets to be used to pay an independent trustee. Or donors who are not interested in complicated or involved, both in quotes, planning. As I said, this is something where there's usually more than one advisor involved. It takes time to think through and to consider all the options, to find a trustee, and then for the trustee to sell assets if that's what's necessary. So it's not just write a check, send it in the mail, be done, or contribute through the website. It's more involved than that. And some people just simply don't have the appetite for that type of a tool. So donors who may benefit from a charitable lead trust, well, wealthy donors who want to utilize the current charitable deduction to reduce taxes, and that's for the grantor CLT. Donors who are willing to forego current cash flow and whose heirs can wait until the end of the trust term to receive their assets. And donors who want to take advantage of a low interest rate environment and have assets that are likely to greatly appreciate in the future.
So now with the charitable gift annuity, there's a lot of similarities with what Johanna talked about with the charitable remainder trust. I mean, these individuals would have charitable intentions. They may have an appreciated asset where they don't want to, which has a large capital gain if they were to sell it. They want to benefit the charity, but they still may need the income during their lifetime. They're not comfortable giving that all up yet. And they like things simple. And this is probably as simple as you can get, whereas you can preserve income and still provide for the charity and avoid any gain on appreciated assets. The other advantage now is that certain individuals who meet the requirement can fund these charitable gift annuities with their IRAs, which would also be helped. Now, when you fund them with the IRA, remember, Johanna brought this up earlier too, that when you die, for the most part, your beneficiaries are going to have to distribute out the balance in your retirement plans within 10 years. And these qualified charitable distributions not only reduce, the balance that are in your retirement plan, they're also going to reduce your future required minimum distributions and what your beneficiaries are going to have to take out over a 10-year period. Because when you think about that, compressing all that income within a 10-year period is going to push your beneficiaries most likely into higher tax brackets than they normally would have been had they been able to take it out under the old law under their life expectancy. So Allison, I have a question for you.
Yes.
What assets would the community foundation accept when an individual wanted to set up a charitable gift annuity? Are there any restrictions?
The two hard restrictions are grave burial plots is a big one, and then basically any asset that can't be sold at some point. So that's really what's looked at. Obviously, charities definitely want to work with donors, and nonprofits want to work with donors to the extent they can. But from the nonprofit standpoint, how long do they want to hold an asset? So I think we have a gift acceptance policy in place. You can actually find it on our website that talks about kind of our process with reviewing and approving different types of gifts. Obviously, if it was a gift of closely held stock, something like that, we may have to do some additional due diligence around it just to understand if there's any restrictions, if there's what this valuation and sale terms look like, things like that. I think the big message is if you have a client that is looking to make a gift of a non-cash asset, contact their desired nonprofit beneficiary upfront and just have that discussion with them. Will they accept those types of assets? If so, what does that acceptance process look like? What things will they be looking for? And then, from a tax planning standpoint, I think it's really important to have a sense of what that timeline would look like, right? It typically take a nonprofit longer to evaluate a closely held stock gift or a real estate gift than it would a publicly traded stock gift or mutual fund shares, right? That's just kind of the nature of it. So I think the best advice I could give is really be proactive, talk to the beneficiary early, really find out what that nonprofit is capable of accepting. I will say we also do work with smaller nonprofits, for instance, that cannot process gifts of publicly traded stock, and we will do that for them for a fee. So some nonprofits don't have capacity to accept every type of asset. So I think it's a really important discussion. Once your client figures out if they have something specific they want to give, it's a non-cash asset, get out in front of it and contact the nonprofit beneficiary and just make sure that you have a good understanding of their process and even their ability to accept the gift before you start moving forward.
Allison, I think that's really good advice. I want to add one more piece, and this was in the materials for charitable remainder trust, and it's just something to keep in mind is that yes, the charity will want to sell the asset because it's going to be hard for them, for either charitable gift annuities or trustees of the charitable remainder trust or charitable lead trust to come up with the cash to make payments. But those assets that are contributed, if they're subject to a pre-existing sale agreement or restrictions on what can be done with it, then they're really not good assets to consider because it's possible that the IRS would look at this and take the charity or the trust out of the equation, and it's just really the donor selling the assets, which would trigger a capital gains tax, et cetera. We want to absolutely avoid that. So this due diligence, the discussion period, again, it's so important for so many reasons, and it I think precludes last minute gifts, but then the nature of this tool kind of precludes it as well. So
Yeah, I think that's a great point, Johanna. And I think, like you said, with closely held, any sort of restrictions, it's very important. Um, I think, there's just also sometimes other considerations with the giving. I think one of the things also to continue consider in your timeline is valuations, right? If you need to have something valued, you need to find a fine person like EG who can do that for you, right? And they're busy, they have schedules, there's timelines for doing that type of work. It's not as simple as maybe calling and trying to make the transfer the next day. So I think valuations is a big piece of things. I also think just understanding kind of, what are the obligations, or what steps of the process will the nonprofit take on versus what they will expect your client to take on as far as providing documentation and, kind of doing their own research. So I think it's good to get all of that stuff clarified up front. And just make sure that, both people are on the same page with how this gift is going to work, if it's going to work, and if there are issues that have to be addressed or resolved, let's get those on the table up front so we can work through them, as opposed to, hitting a snag when we're not expecting that. EG, do you have any further thoughts on that?
No, but
Okay.
I do have one more point. So how
Yeah.
many apples grow on a tree?
Oh,
All of them. So that's my final comment.
perfect. Well, thank you both so much for your time today. And thank you, EG, for all of the knowledge we've acquired on apples. Who knew that
There
was
you go.
Um, but like I said, these are two great experts in the field, so I'm so happy to have them here today. If anybody is interested in a copy of the slides, shoot me an email. I'd be happy to share them. With respect to the topic we just discussed, non-cash assets, there's an article on our advisor blog about that. If you haven't looked at MCF's advisor blog, I recommend it. There's monthly content on there about some of these practical things that can come up in the process of working with clients on charitable giving. I want to remind you one more time, you will be seeing a survey link pop up at the end of this. Please fill it out. That is what I use when I make plans and bug people to speak for me and do all of that fun stuff. I want to make sure what I'm doing is helpful to you and your clients. So if you could complete that survey, it's not very long, that would be awesome. Otherwise, if EG and Johanna don't have any final thoughts, I will just thank them again so much for their time. And I hope to see all of you out there on November 14th for our next webinar. Thank you.
Thank you. Bye-bye.
Thank you. Bye-bye.